Hello, and welcome to our channel. In today's analysis, we're looking at a significant trend in Singapore's stock market, a major surge in share buyback activity. By September 2025, the total value of these buybacks had reached a remarkable figure, signaling a shift in how companies are managing their capital and returning value to their shareholders. We'll explore what this means, which sectors are leading the charge, and what investors should understand about this financial maneuver. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. So, what exactly is a share buyback, also known as a share repurchase? In simple terms, it's a process where a company buys its own shares from the open market. This action reduces the number of shares available to the public. Companies do this for several strategic reasons. First, it's a way to deploy excess cash. If a company has profits that it doesn't need for immediate investments or operations, it can return that capital to shareholders through a buyback. Another key motivation is the belief that the company's stock is undervalued. Management can signal its confidence in the company's future prospects by investing in itself. From a financial mechanics perspective, buybacks can make a company's shares appear more attractive. By reducing the number of outstanding shares, the company's earnings are spread over a smaller base. This automatically increases the earnings per share, or EPS, a metric closely watched by investors. Similarly, it can boost another key metric, return on equity, or ROE. Now, let's look at the numbers for 2025. As of September 11th, 76 primary listed companies on the Singapore Exchange engaged in share buybacks. The total value, or consideration, for these buybacks reached 1.65 billion Singapore dollars. This represents a significant increase, approximately 80% compared to the $916 million spent during the same period in 2024. This surge in activity points to a renewed focus on capital return strategies within corporate Singapore. A large portion of this activity was concentrated in April, which saw $425 million in buybacks, coinciding with a period of market volatility. This suggests companies were opportunistically repurchasing shares when prices were lower. While the headline number is impressive, the story becomes more nuanced when we look at which sectors are driving this trend. The surge is not a broad market phenomenon, but is highly concentrated in the financial services sector. Three major Singaporean banks, United Overseas Bank, DBS Group Holdings, and OCBC Bank, were the primary drivers. Combined, these three institutions accounted for $1.28 billion, or more than 77% of the total buyback value. This highlights that the 2025 buyback story is largely a sectoral one, rooted in the strategic capital management of these financial giants. The industrial sector also showed notable activity, with companies like Keppel, Sembcorp Industries, and ST Engineering making significant repurchases. This shows that while financials are dominant, the trend of returning capital is also present among other established cash-generating companies. The reasons behind these buybacks vary. For the major banks, this isn't a new or reactive measure. Their buybacks are part of established multi-year capital management programs designed to return surplus capital to shareholders. For other companies, the motivations are more specific. Keppel, for instance, is using proceeds from asset sales to fund its buybacks, directly linking its strategic pivot to returning value to its shareholders. We also see a number of smaller companies initiating buybacks for the first time in several years. For firms like AEM Holdings, Kingsman Creatives, and Jason Marine Group, this action serves as a potent signal from management, It suggests a strong conviction that their stock is undervalued and is an effort to improve market valuation and liquidity. To put the 2025 numbers in perspective, let's look at the previous years. In 2023, total buyback consideration was significantly lower at $743 million. The year before, in 2022, the figure was a more comparable $1.69 billion, but that was heavily influenced by a single large buyback from Keppel. The key difference in 2025 is the driver. The current surge is not a one-off event, but result of sustained strategic capital management programs from the dominant banking sector. This suggests a more structured and potentially more enduring trend in capital management on the Singapore Exchange. So, what does this trend mean for investors? On one hand, a buyback announcement is often viewed positively by the market. It can be interpreted as a sign of management's confidence in the company's financial health and future prospects. The mechanical boost to metrics like earnings per share can also make a stock look more attractive. However, investors should maintain a balanced perspective. A study of companies on the Singapore Exchange found no statistically significant link between the amount spent on buybacks and long-term shareholder returns. In fact, on average, returns tended to decline after a buyback. This highlights that the reason for the buyback is more important than the act itself. Investors should look deeper into whether the buyback is part of a coherent, long-term strategy. Share buybacks are not without risks. A primary concern is the opportunity cost. The capital used for buybacks could have been invested in other areas like research and development, business expansion, or paying down debt. A company that consistently prioritizes buybacks over internal investment might be signaling a lack of growth opportunities. In a smaller market like Singapore's, a high concentration of buybacks by a few large players can also raise concerns about market liquidity. When large volumes of shares are taken out of the market, it can make it harder for investors to trade without affecting the stock price. There's also the risk that buybacks could be used to artificially influence share prices, a concern that regulators are well aware of. In summary, the 80% surge in share buyback activity in Singapore in 2025 is a significant market development. The key insight is that this surge, while reaching $1.65 billion, is overwhelmingly driven by the strategic capital management programs of the three major local banks. This signals corporate confidence and an increasing willingness to return surplus capital to shareholders. For investors, it offers valuable insights, but requires careful analysis. It's crucial to look beyond the headline numbers and scrutinize the specific rationale, funding source, and strategic context of each company's buyback program. Understanding the why behind the buyback is the key to interpreting what it truly means for the company's future and for long-term shareholder value. Thanks for watching, and we'll see you in the next video.